He's angry about mortgages. It's Angry Mortgage. He's swearing. He's cursing loud. He's old. He's opinionated. And he's been doing this so damn long. This program is about mortgages, and this is mortgage advice, but the advice may not apply to your situation. Contact licensed mortgage professionals for specific recommendations before you make decisions about mortgages. You may not agree with Ron, but if you don't, he thinks you're wrong. Oh, and did we say there is a lot of swearing?
Okay, we're back. And my guest, this is a special guest. We've had a lot of great guests, many great guests, but this is the guest of guests. So John Webster is just without question, if you're in the mortgage business, particularly if you're in the mortgage brokerage business, for the last 25 years, 30 years, John?
30 plus.
30 plus years. There's been two human beings who have dominated the mortgage business, brokerage business for that whole time, entire time. Stephen Smith and John Webster. Stephen Smith is not coming on my podcast, but I've got John Webster today. And when I say that he is dominated the mortgage brokerage business through Maple Trust, which you founded. Well, you founded it. Let's just call it that. Won't go through all the permutations, but you founded it. And then Scotia Mortgage Authority, which for, I don't know, a full decade, John, 15 years was the biggest thing in the mortgage brokerage space. That's fair.
Certainly, Stephen was number 2 or 3 for that period of time.
We're not beating up on Mr. Smith in any way.
It's just a fact, just stating the facts.
Yeah, I got to avoid beating up on Mr. Smith. But look, hey, by the way, it's pretty fucking hard not to be respectful for Mr. Smith. Somebody who's made that much money. Holy mackerel. What about a bunch of money he made?
No question. He's been the most successful. He's monetized mortgages better than anyone in Canada and certainly on a par with anyone in North America.
100%. Now, that said, John Webster has made more money for mortgage brokers than anybody in the history of mortgage brokerage. That's the truth, too. Absolutely. So if Mr. Smith is wisely, he's made a lot of money for mortgage brokers and will continue to through his various operations. But John in his day, without doubt, put the most commission into the pockets of mortgage brokers than anybody else in this whole country. Although mortgage brokers will tell you they did it all themselves.
Without doubt.
Without doubt. They did it all themselves. All right. So, John, tell us a little bit about the start with Maple Trust and the conversion to Scotia, and it's a great story. Tell us about it.
Well, just on that theme, I think we should do a shout out to Yuz Basada.
Yuz,
who
yes.
was just announced as the vice chair of the new Fairstone, which is Home and Fairstone and all the Stephen Smith enterprises put together.
Yep.
And I just want to say, having known Yuz when he ran Philogix, and I was actually a board member, Maple Trust was a shareholder in those days, that he took on that home trust during the most difficult circumstances imaginable and provided great stewardship in the space. So I think we should, Stephen ended up buying that business. First time it's a venture that's just Stephen Smith without partners. When he bought Canada Guarantee.
But it's back to partners now.
But in the beginning,
Yep.
Canada Guarantee was a partnership. When he took over AIG's insurance with teachers, he and Maury were partners in First National. Even when he launched his subsequent endeavors, including Fairstone, he had institutional partners.
Right.
But he took that step all on his own. And now he will obviously look at the shareholding that's appropriate and will attract, I'm sure, many investors into the new brave world. But Yuz took over Home when there was a run on Home and on the banks, and in my view, helped the whole space. So I think we, as much as we want to celebrate Stephen, because he is without doubt the most successful person in the mortgage business in Canada historically, and not only that, an incredibly generous benefactor to Queens in particular, first the Smith Business School, and then donating $100 million to engineering. So, I mean, I've known Stephen a long time, and I do admire him, but I did enjoy beating him.
That's a great shout out to Yuz Basada. I had a front row seat to the first year when Yuz was resurrecting Home Trust. And I firmly believe he worked 340 days out of a year because I saw him at every event. I saw him on the weekends. I saw him on, literally, if there were two mortgage brokers in a room, Yuz was there. And being his generous and kind self. And yeah, you can't bring a business back from the brink unless you put in all that time. And he did it, and it worked out. And
it's worked out for him. We don't have to have a tag day for usury.
No.
Buying a new Porsche or whatever else he's doing.
No. But like whatever good things have happened, all earned.
I agree.
All earned, every nickel.
And I think you and I both would celebrate the success that he's had. And also, I would say I give Stephen credit for what he's done in the space. He has a vision. He not only will make money for himself, but he'll be innovative and he'll be competitive. And even going back to when First National was taking off, you asked me about the history of Maple. I had started out with Maple Trust as a new entity, basically a startup, rolling in a predecessor company called London Trust for the regulatory approvals and the corporate structure. And then I sold the portfolio because the people buying it, which included teachers and First Marathon, which became National Bank, they didn't want any of the portfolio. And so I sold that actually to Jerry Soloway at Home Trust,
right.
Which is another story. But I'd known Jerry for some time prior to that because all of the predecessor Ontario loan and trust companies, we all knew each other back in the day. And essentially what happened was Ontario and the feds decided to migrate everyone into the federal jurisdiction. So I was regulated in Ontario, migrated London Trust into Maple Trust into the federal jurisdiction, started Maple Trust basically as a regulated entity, unlike MCAP or FirstNat, but with a vision only to originate through brokers. And started it as a bit of a pilot in Toronto. And it was interesting because First Marathon as a shareholder had been in the business with First Marathon for many years. And Lawrence Bloomberg, who was the principal of that firm, was not impressed in my board submission when I said that in 6 months I would do what they'd done in 5 years. And,
he was less than pleased.
Less than pleased. He thought that I was not only being too ambitious, but not just realistic, but casting aspersions on the efforts of First Marathon at the time. And unfortunately for Lawrence, I did it in under 6 months.
Oh,
and
you just took it. You could count the weeks.
And I knew that if that was successful, Ron, in Toronto, what I basically did with, including with one of your predecessors, I created a focus group of brokers. I started with Brokers First, and we whiteboarded it. And I had my friend David McNaughton, who went on to many successes, and most recently had been the Canadian ambassador to the U.S. and negotiated the last trade deal. I asked him to be the facilitator. So we whiteboarded, and I grabbed a group of prominent brokers at the time and asked them what would they want to see in this new entity. And they came up, we decided on 10 items over several months, and 9 of them would have bankrupted me and 1 or 2 worked. And those were the ones that embraced, which led to the creation of the BRM model, having a broker relationship manager who was the underwriter, who was aligned and compensated on a variable basis like the brokers. That was probably one of my biggest achievements to get that past the regulator, because obviously they thought there was opportunity for self-dealing and were there enough checks and balances. But what it did, Ron, and you experienced it when you became a mortgage broker and dealt with Maple Trust, was that it allowed people who had a lot of experience as a mortgage specialist, a lot of underwriting experience at other institutions, to make a decent living wage and be paid when they were successful. And so their appetite was enormous. They were willing to work on evenings and weekends when realtors were working and when you were trying to get deals done. And it wasn't based on banking hours. And it also demonstrated the capacity, like their productivity was 6x to anything else that I'd ever seen. So we were able, when I started Maple Trust just in Toronto with 6 BRMs, to basically put up the equivalent volume of what underwriting teams in the other institutions would take 30 or 40 people to do. And I'll tell you one story. After I sold Maple Trust in 2006 to Scotia Bank, they had all these underwriting centers along with fulfillment centers. And I didn't understand why. And the underwriting centers would process a lot of paper, but their look to book was very, very low, probably half of what the industry average was at the time. And I had one BRM named Frank Terraport, who is retired from Scotiabank now. And one month I said to Anatol von Helm, who was running Canada at the time, Anatol, this BRM did more than the entire Calgary operation, who has 200 people in the same month. What other proof point do you need that we need to close these centers and just commit to a BRM model, which we did for the sales force. And that model has led me to my next endeavor with Maple Financial in the private space to bring that same kind of service and capacity. So I would say that changed the game for brokers because there was total alignment. You dealt with one broker relationship manager who understood what Butler Mortgage needed. We made sure you understood what was in our window and what we had an appetite for. And then to complete the triangle, we had a dedicated funder. So the broker who was submitting dealt with someone who could make the decisions, not deal with a happy face BDM who never got back to you or did or said, oh, let me call an underwriter. So there was not a lot of broken telephone. You got to deal with the decision maker, and then the funder who was funding your deals was also within that virtuous circle. And I think that most people are still stuck in that old paradigm and didn't understand why this worked. The challenge was with the regulators to make sure there were enough checks and balances to make sure that there wasn't the temptation to have self-dealing or to favor the broker, because they had the impression that if you were variably compensated, then you would be incented to improve any deal. Quite the opposite turned out to be true. Brokers who were good partners wanted to continue the relationship and didn't want to send you paper that would end up damaging that relationship. The BRMs, we developed a very vigorous scorecard with clawbacks and double clawbacks, but we used to publish those numbers every month so everyone knew where they stood compared to their peers in terms of delinquencies and what we called green release, which was how many days till the deal got approved, no longer conditional and funded. And as a result, there was a lot of pride in the modeling efficiency. And I used to be very satisfied that you could send us a deal and in 48 hours, if there weren't too many dangling participles, we could put it to bed. Whereas in the US, with all their technology, it might take them 6 weeks. And certainly at the banks at the time, it would take them 5 to 10 to 15 days. So speed kills. And that model has been very agile and successful as a result. And I think that was an innovation. And for some reason, other people have tried to imitate it, but they've never done it successfully.
Well, let's speak to that. So I go think about what John is and his group. His team is a great team. And many of them continue to be great influence in the mortgage business. But the key breakthroughs, the idea that someone could work from there. By the way, this was before anybody worked from home.
All remote.
This is before, like, nobody had ever heard of people working from their homes. We were
COVID before COVID.
Yeah, yes. Exactly. Yeah. There was literally nobody in the mortgage business could believe that a person could underwrite a mortgage from their basement. And that was how John started. Yep. And nobody believed, to your point, no regulator, nobody in a bank believed that there wouldn't be rampant problems with people.
Well, you'll recall at the time, banks were not big believers in brokers as a distribution channel. They thought they were the cause of all the frauds.
Of everything, every bad thing that could happen
no
in the
renewals,
industry,
delinquencies, yada, yada, yada.
But let's talk about those breakthroughs. The idea that someone could adjudicate a mortgage on a variable comp basis and do it from their home and save a ton of money and be far more effective, work when they needed to work a long day if they had to, because there are a lot of new mortgage submissions.
Well, a lot of women that had children, it allowed them to work and still maintain the household, look after their kids. They could work when kids were at school, when they put the kids to bed, work on the weekends and evenings, gave them that flexibility and added to their productivity. And in the bigger cities, we were saving a couple hours in commute time, which was dead time, right?
So the most, when we say all this, it's 25 years ago. Literally no one, and every single bank executive and lending executive told John he was wrong. Every single one.
Everyone.
Okay, every single one. So
every regulator,
it would never work.
Bank CEO,
it would never work.
Yeah.
So the process John went through of creating is so robust checks and balances and pre-funding audit, post-funding audit, the level of diligence that went into it. And it all worked. So even though you're right, today, there's probably no perfect model emulating what Maple and Scotia did. There is an attempt to do it,
yes,
all over the place, because this is what was discovered.
But when I talk to those lenders today, unencumbered as I am, they're not 100% variable. There's some fashion of
sure. Some inducement. Some inducement. Because what John discovered and what then eventually the bank discovered was, if you don't have to pay on unfunded mortgage, if you only pay on funded mortgages, there's some miraculous efficiencies occur.
Incredible.
And that's what now let's go on to the other big
and also you have a group of people in the bank case where it was all pensionable time, right? So they didn't mind processing paper, which would make me I just couldn't understand that we would just spend a lot of time processing paper, sending out commitments when they weren't even signed back. And the reality was losing the deals as opposed to having someone who had the ability to make the decision, give you a rate and a commitment, and give you a date that it was going to fund. And as the brokerage industry continued to grow, they responded to it. The other thing that I would say that is a difference, most of our competitors at the time thought that lending was a democracy, and so that every agent, regardless how skilled or how experienced, was entitled to send to you. I quickly decided that I wanted to deal with the best in class and told them, thank God there's lots of choices in the industry. You're free to go deal with them, but if you're going to deal with us, you're going to deal on these terms. And that allowed us to build a culture that I believe was best in class, the best practices available. And certainly what I think the default insurers would tell you was, in our quality assurance, they were very surprised how clean the high ratio book was compared to peers and the banks in particular. And then at the bank, the internal audits were stunned that the broker business was the cleanest business of all the business, including the sales force, and over
to this day. Yeah, to this day.
And that was myth busting, right? Because as you said, every bank CEO that I talked to before I ended up selling Maple Trust to Scotia Bank believed that brokers would be basically cannibalize their existing business.
So the other big breakthrough, which you just alluded to, but I'll drill down on it a little bit. The great thing about the mortgage, the difficulty of the mortgage business prior to the growth of John's concept was that mortgage brokerage owners wanted to control the whole story of commission. They wanted to keep everything a secret, and many lenders agreed with that. Kept things a secret, and it was very, very hard to know for many brokers, for many mortgage agents all across Canada, what in the world was the lender actually paying.
There was no transparency.
None.
So the volume bonus system, to me, wasn't transparent, wasn't fair. The people I wanted to deal with were the Ron Butlers that produced the deals, not the broker who was an aggregator who just wanted to get paid because he had Ron Butler as an agent. That didn't make, to me, the incentives weren't aligned.
Correct.
And it wasn't transparent. And then when the aggregators took over, like whether it was Mortgage Intelligence or Invis, they wanted to continue with the same thing. They used to, as you'll recall, they'd come in and say, you're going to pay us the volume bonus just like you pay everyone else, or we'll kick you out of our system. I said, go ahead, because every time you do, my share goes up. So the agents were always happy. I mean, Andrew Moore will tell you the story of how he and I nearly went across the table to each other when he was running Invis, when I told him I wasn't going to pay the volume bonus. And, it wasn't any different when Gary and Chris started DLC. They thought that they were entitled. Their business was to recruit and aggregate, and they wanted their share, the lion's share of that volume bonus. And so we had to basically come to an understanding to say, look, we got into this business. First Line and CIBC were out. First Line was created by the sale of Council Trust, which is a whole other story you and I could talk to on.
But we need to consult lawyers first.
Exactly.
I think some of those guys are still around.
But CIBC was getting out of the business when I got into the business at Maple. First Line was dominant. You were a big First Line guy when you started. And they had the trinkets and trash point system. And also you could buy down the rate to compete with Salesforces. And I got that. And I looked at all this arbitrage that was going on in Treasury at the bank, and I said, it's not sustainable. And as a result, they ended up exiting the business. But by the time that I went to Scotia, one of the achievements I was, I think, proud of, and I think rightly so, was to bring Scotia into that space, because the brokers needed a bank, particularly when CIBC exited.
Brokers always need a bank.
And BMO exited, right? People forget CIBC and BMO were in the space, and they left. And I came in and was a bit of a savior in terms of, particularly in the prime space, to allow brokers. And because the model was so successful at Scotia, it quickly went to become more than 60% of all originations.
That's true.
Which really, I think, turned a lot of heads. Competitors' head, bank analysts started to say, how are you doing this, right? And that was a combination of the model, a combination of how we selected the people we wanted to do business with. And you're right, we had a bit of a complex matrix, having to do pre-funding, post-funding, and being pretty careful. I think most people in the industry in those days knew that if you got a call from Doug Robinson, that wasn't a good thing.
Nothing's changed. Look, the best possible summary would be, again, I keep referencing this, and yeah, I get it. Mortgage brokers, mortgage agents push back on this because their belief is that their creativity, their attention to detail, their perseverance, their marvelous charm is the reason for their success. But I will tell you that mortgage brokerage without lenders there's no mortgage brokerage. And John's breakthroughs, massive breakthroughs, which favored just the individual broker. That's the truth of it all. Yeah, the networks did fine. But the reality is that a dedicated underwriter working just for the mortgage broker, working after hours, working some weekends, which you can't talk about it anymore because there's a bunch of legislation about that now, but working with aligned interests with meticulous review, it's fair to say. And finally, the guts, the boldness to say to all kinds of brokerage owners, actually, I don't give a fuck what you think. My position is that if the person who's pushing the button, sending the mortgage to my organization, that broker is the person I want to pay, and I want to pay in a transparent way, and I want to pay them what they deserve. And those two things resonated throughout the entire industry to this day. And that's the reason why mortgage brokers make money.
There's another aspect to this, setting up the BRM model in terms of the checks and balances. One of the challenges was the BRMs would come and say, I have a relationship with broker Y or Z and I want to deal with them. And my approach was, no, let's have a discussion about it, because it was important to me at the time, and I instilled this in management, to say we need to control that relationship as well, not only from a credit quality point of view or from a value point of view, but also a relationship point of view. So I wanted Ron Butler to know he had access to the executive team at Maple or at Scotia on a relationship basis, that was part of the value proposition. that was unusual in the industry, because what I experienced when I got into it was most of the executive of our competitors, when they went to a conference or a social event, they'd hang out with each other, but they didn't want to talk to brokers.
Yeah, that's all true.
And I was different in that I was always accessible. And I think I built really strong relationships with the people that were our good partners. And part of that was to take the BRM out of the equation. So we do these trips people thought were fanciful and on a reward basis and surprise and delight. But part of that was building that relationship, because we weren't in contact with the BRM every day, and we weren't in contact with their broker, and we needed to build a relationship. And it helped the BRM, because the things that the broker didn't want to say to destabilize the relationship with the BRM, who if they submit deals to, they could say to us, and then we could work. And the same thing was true of the BRM. BRM's having trouble with the broker, then we could go to the broker on that behalf. And I think that in terms of the ability to influence and create a better outcome, whether it was a credit decision or a relationship decision or change the person who was managing the relationship, was very successful. And as a management group, we spent pains to monitor that. Not like, I didn't just monitor it like monthly or quarterly. I looked at the numbers every day to see who was up, who was down, who should get the hockey tickets next, who should sit on the floor with Superfan. Like, that was important to me, because I knew it was important to the brokers that were submitting, because they wanted recognition and status, not just the money. Some of the houses just didn't get that. Right. They thought, why don't you spend time with us?
Why don't you take us on a trip?
But you don't send me any deals. You don't even know how to submit a deal.
Yeah. You have an you are just an administrator.
But we also, developed good relationships with those houses that would cooperate. And one of the conditions I had was I had very little tolerance, as you know, for bad behavior. So if someone was misrepresenting or doing a deal and they were part of a brokerage that was very successful with us, I used to tell people in the early days, like, these are capital offenses. Like, if you blow a fraud by us, you're cut off for life. Right. And that was unusual, particularly in the sales forces, still to this day at the banks. If someone has, an important volume, unfortunately, people will look the other way. And I thought that was a mistake, because I think the biggest risk in the broker business still today is reputational risk.
100%.
And I think I tried to pay a lot of attention to that, not just because I was regulated and the others weren't. I thought that was, as a financial intermediary, how are you going to build the trust with the consumer unless your integrity is the most important thing? So putting people in the right deals, in a suitable mortgage for their circumstances, that kind of advice to me was important. Not just stretching on a down payment or an income or playing those kinds of games, but being truthful to your customer. And I think that the culture that we created, and I think that that's still the case today with the BRMs, that they held themselves up to their own standard. Because, what's important in a business like that is not what people do or say when you're watching them or you're in the room. It's what they do or say when you're not watching them and you're not in the room. Right?
Always the case.
And I think we had a good group that understood that. Like everyone, we had our exceptions.
Sure.
But
as Joe Rogan says, there's the majority of plumbers are great plumbers, but at the end of the day, there's a few plumbers who will fuck you.
But we never had anyone, like, we never had to advertise to get a BRM.
No,
that was
never,
a destination of choice, right?
Never.
People that understood that they were good at mortgages and liked housing Canadians and got, some jam out of that and liked it and weren't scared to work hard and with speed, they were attracted to positions. And so we were fortunate, because even in the beginning, most of the underwriters that we hired and became BRMs had many years of experience. And they were, they could have been at TD, they could have been at MCAP, it didn't matter where. They came to us as a destination, and they were demanding jobs. They do a lot of volume, and they're still increasingly demanding. Because one of the things you don't want to do is kill the golden goose, is bureaucratize it all. And banks love process, and they'll build process around process.
The whole country loves
process.
We have
Polyev doesn't like process. He's going to burn it all down.
Polyev wants to have fewer referees. Yeah, that's for sure. So, quick editorial note. Andrew Moore has gone on to be a fantastic person in our business, and has done
Well,
we got to be fair. A
Equitable
spectacular job. A
Equitable is
spectacular
the
job.
darling of the street. Back in the day when you and I
Spectacular.
were doing this, starting out, Home Trust
That was a dog's breakfast. Equitable was a dog's breakfast.
Equitable was not what it is. Nothing that it doesn't even represent any kind of facsimile of what it is today. But Home was a darling.
Yep.
And now Equitable's a darling. Equitable's the bogey for anyone who wants to challenge their bank. Andrew's done a fantastic job there. Interestingly enough, Stephen Smith's still the largest single shareholder of that. So
hasn't sold.
And says he's buying more.
So yes, another shout out to Andrew, who has some really a remarkable job in banking ain't easy, and you know that better than anybody else. Banking's not easy, and he's done a fantastic job.
No, I think that when you look at the other institutions that aren't among the big 5 or 6, the bogey is Equitable now.
Yep.
And Equitable's been incredibly smart about how they manage their capital. Andrew understands what return on equity looks like. He's good with people. He's hired good people. I absolutely agree. Equitable is not the institution it was when I started.
Oh, it was ridiculous. It was ridiculous back in the day. It was like a little fiefdom of a particular man.
But like anybody in those spaces, right? Like in my view, is that other competitive entities. It's hard to get a bank license in Canada, and it's hard to keep it. But other competitive entities will emerge, hopefully, and create some competition for Andrew. And I'm sure that Stephen has his sights set on that as well with the new Fairstone Bank.
Listen, I mean, if you can develop a successful bank, it can be very lucrative, but it's tough.
The problem is that the regulatory, as we know in this industry and the mortgage industry and your listeners, the amount of regulation in mortgages today is overwhelming and continues, and it's not going to change with AML, money laundering, and foreign interference. All of these things are real issues, and they require a lot of infrastructure and fixed costs for compliance, for internal audit. And it's very tough to start a small lender today because those are fixed costs that you must have. There's no proportionality when it comes to meeting the regulatory hurdle.
No, there's none.
So you have to have those things. So that's a barrier to entry. And then I agree with you. Like if you can get it right and you get the capital and you've got the right vision, I think the mistake that's been made in the space that I've witnessed is that people that got into the banking wanted to emulate what the big banks were doing. And that's a mistake. That's not what Equitable did, mistake, right? Yeah. You need to figure out that you're a boutique or a niche, where you're going to take your shots, what you're going to be good at, develop a specialization where you're more nimble and you can provide that service and get a better return than the dominant players. Because it's even true in the mortgage space, nothing has really changed. Like the banks in the prime space today are overwhelming.
We could spend probably another whole show talking about the fallacy of fintech in the mortgage business, because we got a long list we could review. I mean, it's a big list, but to your point, not really a whole hell of a lot has changed because it's a highly regulated business.
Well, I think that
all you can do is speed application.
I would say automation has improved the business.
Yes.
I think that fintech was largely misunderstood. It was very frothy because people thought that there was going to be a solution in technology,
a magic bullet
to replace the intermediation by people. And I don't think that'll ever happen, even with AI. AI is so unreliable that you're always going to need a human to check it, and you're always going to need an off-ramp to a human. I mean, it always amazes me, and I've said this to you and on other podcasts, don't want to repeat myself, but even the most financially literate people need help with their mortgage, whether it's because they don't have time or they've got a spouse or a family member and it's an emotional decision. In the home buying journey, you need an intermediary that helps them through that process. Even with AI, that's not going to change.
No,
in my view.
It will not.
And I think that there's a bit of a bubble emerging on AI as a solution to everything. Now, having said that, the tech stacks in our industry and some competitors are using are so dated that they desperately need to be replaced.
Of course, that's absolutely true. That said, though, to your point, the idea that a better, more robust, and faster application process is a magic bullet is a complete fallacy.
A total fallacy.
Total fallacy. And yet, we've got venture capitalist after venture capitalist is happy to throw money at it. Like, not anymore. Those days are over. You know, if you're a particular fruit brokerage, I mean, that might be the end of the gravy train.
Well,
But,
you know, Ron, I lived through this digitization, and I did it knowing that it would not create a material share when we created eHome at Scotia in order to demonstrate that you could go end to end on a digital basis.
which, by the way, is still the best system.
It still is, but having said that, I knew it was never going to be a material part of mortgage origination, given what's required, right? But you had to do it to fend off the fintechs, because they were going to all the board members and senior executive of the bank saying that there is a magic bullet. And I knew there wasn't. But so to get out in front of it and to demonstrate that you did have that capability, but what could it really do and under what circumstances? So I think that, you know, my view was that we moved to an age of digital plus, but we're a long way from that.
To your point, there is the whole basis of an intermediary to assist in a mortgage transaction is that something you might own, the consumer only does every 3, 6, 7, 5
well,
years.
and thanks to our friend Peter Rutledge, he's made it so complex that you need someone who does it on a daily basis to be able to divine what will work and what won't. And we're going to talk about that, whether it's the stress test and now LTI. You know, B20, I used to say this to people in audiences, like, even the analysts didn't understand in the beginning that it wasn't a multivitamin, that it actually was a requirement on what you were allowed and what not to do. It was so prescriptive.
Well,
right?
let's talk about that for a second. So let's think about what is going to be big in the mortgage business, key to housing, and where we're going to see some rates possible. And you and I are of the same mind. It's ridiculous to try to predict rates.
Which makes me wonder how we're going to do this debate in March when we agree on too many things. We're going to have to figure out.
You know, I guarantee we can find things to argue about.
Okay.
I'm so
but
sure.
Related to mortgages, I mean.
Well, we'll find other things. Another interesting thing is there's a bit of a pushback. That same organization, I'd put on a bit of a kind of a frenzied, profane presentation to that organization, which was well received. But one of the directors felt it was a few too many F-bombs. So we're going to have a sort of an F-bomb governor on that discussion. But I think it's going to be a lot of fun anyway. So all right, let's start with housing, which you and I both know, particularly in Ontario, has gone completely to hell in a handbasket.
Yeah, I think that, I mean, what people misapprehend, and I used to do a quarterly podcast at Scotia, and we talked about housing a lot. And what people didn't understand was the two big drivers of housing outlook in Canada and in Ontario in particular have to do with household formation. And household formation in the Canadian context is driven by immigration. And so we've gone through, as anybody knows, and we've all experienced, record levels of immigration.
Uncontrolled levels of immigration.
As it turned out, the Trudeau government had increased immigration without a plan. And that put more stress on the housing market, particularly in the rental market. But what I was going to say is that people don't understand that what drives housing demand has been immigration, always in Canada. But in the last 10 years, we went from 200,000 to 1 million at the end of the pandemic of new Canadians in 1 year.
Yep.
At the same time,
and half of them came to Ontario.
Correct. And so now, typically, if they didn't come here originally, what would happen in immigration patterns was they'd end up in Toronto, Vancouver, or Montreal,
Correct.
or the larger urban centers,
Correct.
ultimately, even if they started somewhere else. And lately, there's been a big net migration again into Alberta as that economy has improved.
Mm-hmm.
But the reality is household formation was so rapid. And when I started in the business, what would happen, say, I'm just picking numbers out. So in the late 80s, we might be building 500,000 new homes, and there'd be 250,000 resales, say. But what happened over the course, it flipped. So now we'd have 500,000 resales, and we'd be building 250,000 new homes. And so as this immigration waves came and more people are seeking housing at all levels, the reality was we hadn't created or built enough dwellings, and we weren't building enough dwellings, and we couldn't accommodate this increase in population. So now we're 41 million. Not that long ago when you and I were doing business, we were 30 million.
Correct.
And we were building more houses than per capita than we are today, particularly in Ontario.
Far more, yeah.
And so that's my view on the housing outlook. Even with retrenching on immigration and cutting it in half, there is so much demand that's going to take place because of the new Canadians that have come for the next 10 years. There'll be more demand than supply. In addition to that, millennials, who are the next big bulge bracket and have affordability challenges that we should speak to, want to get into the market, but can't. But even if there's not enough supply to allow them to get in.
Yeah.
When we started this, the first time program to me was the best in the G20. Incredibly successful program.
Best immigration program.
Best.
Absolutely.
And first time buyers had access, and the price point's gone up, and people go, why has housing become unaffordable? It's supply and demand. Too much household formation, overwhelming numbers of new Canadians who we need for our economy, this ribbon economy. We need these people to come, bring their skills, their wealth, their ability to work and be productive. But at the same time, we can't bring them here and not have housing for them. And what we've done in this country, and I've talked about it a lot, in terms of new construction, we have municipalities that are so slow to approve new construction and intensification and do the zoning that's appropriate. And then we charge outrageous amounts of levies, the highest. So we're in a situation in Ontario where it's the slowest to do approval and the most expensive, and it needs new housing the most. And so the province, and Doug Ford, he has the right idea, because municipalities are all creatures of statute here. They're controlled by the province.
Yes.
But you and I both know this. We live in houses and we pay too low in terms of our municipal taxes.
Ridiculously low.
But we whack anybody who needs a new home with all these levies for the municipalities. That's got to be addressed.
Touch on Peterborough. I love this one. This is fantastic.
So you and I were discussing, how much are the levies now? The new home folks put out stuff, and you were talking, it was 165,000 in charges in Mississauga. I've seen some data that says it's upward of 300,000 for
houses,
a single family
big
dwelling,
houses,
bigger houses. And I know that you
which
would,
makes no fucking sense.
No sense.
Okay.
And you in particular have called out that we built all these condominiums for 400 square feet that no one wants to live in, and that's another issue that's got to be addressed. But I have a friend in Peterborough who owns a number of rental properties, and he was trying to redevelop a central block in Peterborough, and he was having a lot of resistance from the municipality. And he said to me, I said, why didn't you go for it? He said, John, the levy per door, apartment door in Peterborough now is $70,000. His acquisition cost of his existing portfolio was below $70,000.
So his acquisition cost of the units was, and he wants to improve and expand and create something that's good.
And this
for
is
the
Peterborough.
Community. It's Peterborough. It's middle of fucking nowhere, really. We still live in Peterborough. We love Peterborough. We're not loving Peterborough. But honestly, the levy to build something better, newer, more efficient, something that people will like, $70,000. He never even paid $70,000 per unit to buy the stuff in the first place.
And why I believe him in terms of his own experiences, he's never sold any real estate that he bought. So he's kept it forever, and he's got his kids, and he's facing the capital gains dilemma and all those things. But he wants to build rental stock, and he wants to keep doing it. And, I have another friend who who was telling me the same story, owned a big property across from one of the GO train centers and in Mississauga, and they wouldn't give him the density. That's where we need to build density around infrastructure.
On the fucking GO train.
Yeah,
absolutely.
And these municipalities, I think that Doug Ford should get some credit because he's calling them out, and it's about time.
Nothing's fucking happened.
I agree.
Okay.
But I go back when I was at law school studying land use planning at the end of the 70s, right? That legislation's the same then.
Same.
It's crazy. And the country has changed so much, and the needs have changed so much, and the demands have changed so much. And then what really frightens me more in terms of the overall macro context is, even the big U.S. hedge funds, if they want to come up here and build, foreign capital doesn't want to come to Canada right now.
Not as penny's worth.
No,
nothing.
And we need that foreign capital to help build. And they're reluctant to come. Our own builders and developers don't want to make that investment because they're not sure they're going to be able to get a return on the money. Construction costs have been out of control. They're not sure they've got a skilled labor force. We haven't been incenting the right trades to come to Canada and fill those gaps as an aging labor force. These things we've known about for 10, 15, 20 years, and we're all aware of it now. It's become a political issue. Why do you think millennials are so pissed off at Trudeau in particular and are embracing Poilievre? Because they can't get into the housing market and they want to do what their parents did and they can't access it. Even if they have the bank of mom and dad, it's impossible. And so they're frustrated, right? And they should be frustrated. And now they're getting angry. And what have we done as our generation? We haven't done enough, all of us collectively, to make sure we're building more dwellings.
Well, you and I are trying to make our case.
I know, but no one's listening.
But no one's listening. So touch on this one for a second. What the fuck with the Greenbelt? I mean, there's got to be changes. There has to be. We are in this incredible Vancouver. I get Vancouver. We got mountains. We got rivers. We got the ocean. There's only so far you can go. I'm fine. It's geographically constrained. Agreed. This province of Ontario, we got a GTA that they've built an artificial moat around that you can't build any housing on. And the one time that the premier tries to take a shot at doing something, unfortunately, he does it in an awkward way. We'll call it awkward as fuck. And it all gets retracted. We have to do something with the Greenbelt, for Christ's sake.
I mean, the challenge was in the conservation authorities. I think there was concern for the aquifer, and they had good intentions to try to protect it. What they didn't realize was we had not provided the infrastructure anyway. So there is no water, there's no sewer, there's no way to connect, right? And then they put this artificial barrier up to say we're going to protect this green space for the aquifer, and then we're going to protect farmland. Meanwhile, there's been consolidation in the agribusiness. Like it isn't planning the way that it should be. That means that the feds, the province, the municipalities on all levels have to say, how are we going to house our population? We have to make some difficult choices in order to do that. And you're right. People were against tract housing and saying we're going on endlessly expanding and they're not energy efficient. Well, the energy efficiency thing has changed. The reality is we do need to bonus density where we can, where there is infrastructure, but we didn't build the infrastructure. We didn't look at rapid transit. It's been a disaster.
Unmitigated disaster.
Unmitigated disaster. But that's what we need to do is we need to bonus density where there is the infrastructure, even as bad as it is, and then expand. But now we have total gridlock in Toronto.
So, it's beyond belief. It's interesting when I talk to the people I know within the soon-to-be new government. When I talk
We're talking about Poilievre's
new government. I'm talking about Poilievre's new government because I'm just going to start saying that from now on. I'm just going to start using the word the new government because it's inevitable.
Well, we'll have a new prime minister before we have another new government. Yeah, but maybe for only about 2 weeks.
Maybe we'll end up with the honorable member from Beijing. Ms. Clark, that's possible.
I don't think that's going to happen.
Me neither. But look, I think we can also both agree.
And I like Christie. So
can we also both agree that if it's the former finance minister, it's just another version of a catastrophe for the Liberal Party?
Well, I think it's going to be very difficult for her. We're venturing off into the hurly-burly world, but it's very difficult for her to demonstrate to Canadians that she can provide separation from Trudeau's agenda because they were joined at the hip. And Trudeau, even on his way out, gave Poilievre the commercial that he'll run over and over, that they were totally partners in this enterprise.
The knife was well plunged.
Yes, the knife was well plunged. But the reality is, I agree with what John Manley said on the occasion of Christia putting the knife into Justin. He said, you can't claim virtue out of that when you only did it when you got fired and you'd agreed with everything else, including
until that day,
including this incredibly irresponsible giveaway. Now, I believe she resisted that, but she went along with it. Like John Turner resigned on principle over creating another deficit.
You'd be the last one.
But if you believed as a finance minister that wasn't responsible, then the thing you do in the parliamentary tradition is, and you no longer can serve, you resign. You, on principle. You don't wait till you're getting a job change or demoted and then make a virtue out of it. So that troubles me a little bit. But having said that, I think that what troubles me more about the current government has been not only their antagonism to business, but not understanding how Canada needs to create wealth, which includes screwing around with the capital gains tax, not understanding what you need to do to create wealth and jobs. And I think that's been missing for a long
Wealth
time.
and
Or
jobs.
spending out of control or hiring out of control, all those things.
The growth of the federal government is beyond comprehension. I mean, it's just
It is.
not even
And
rational.
I think that Polyev will address that immediately. He'll go in and start slashing.
Yeah, whatever you do, don't go long on Ottawa real estate. There's going to be some houses for sale, folks. I mean, there will be, under the new government, there will be some layoffs without any question. So, I mean, look, nobody ever wishes people to lose their jobs.
You know what? They say that in Washington too, but real estate prices don't go down. So
No, they don't. And
politicians tend to make those statements, and the cuts were replaced by other spending typically, right? So
I feel, I have this deep feeling though that there will be less bureaucrats in Ottawa.
I think that's automatic.
Yeah.
And in Ottawa, at least, they don't even have any longer a commercial component when you're going for rezoning, right? They don't require no, but why would you? But we still have it in all these other urban centers.
All right, let's talk about the mortgage business for a minute.
Yep.
So there's nobody that I know who can give me more insight into the coming establishment of LTI and how it works within the confines of, and why do we have a stress test and LTI at the same time? They got rid of that in Britain. So enlighten me, please.
So in terms of the stress test, I mean, we've talked about this before, and I think it's better understood. But just to review, the stress test was implemented to say that there was this Bank of Canada qualifying rate, which currently is 5.25%. And what happened was the rule came in to say to lenders that you have to qualify the borrower on the higher of 5.25% being the Bank of Canada qualifying rate, or the contract price plus 2%. And when that was done, the algorithm that was developed, it was really done for the smaller lenders who weren't bound by B20 to make sure that they were already charging 5.20, and so they could get away with just underwriting at 5.20 when that was their coupon rate. And so that was the argument, at least when I was at the table with OSFI and in the CBA meetings. And they wanted to provide an interest rate cushion, and I think we both agreed that interest rate cushion was successful and prevented a lot of payment shock for people that had ultra low interest rates and then now have been renewing into higher rates. They were able to sustain that because they were underwritten using the Bank of Canada qualifying rate or using the stress test.
Yeah, we've been through this massive,
Yes.
we went through a massive up cycle in real estate, in interest rates, and yet we're still some of the lowest default rates.
Exactly.
Exist, so.
And that's always been the case in my view. Canadians are very responsible when it comes to their mortgage debt. Typically more Canadians didn't have mortgages than have mortgages because they pay them off. And in my experience with borrowers, they always want to escalate their amortization schedule, do biweekly or double up on payments to get that AM down because they want to pay off that debt. But what happened was in the pandemic, with all this activity in housing, a very, very heated housing market where people were spending a lot more time thinking about the house they wanted to have and going further afield and doing all those things working from home, what was missed was in the variable context, when the variable payments were so low, it didn't protect variable borrowers. And in England, they abandoned the stress test for this loan-to-income approach, which is the new regime as well, LTI. So now OSFI has said that only either 15 or 25% of your portfolio, depending on the lender, can have a loan-to-income greater than 4.5 times. So that means that you can't have people in your borrowing portfolio that exceed 4.5 times their income. So if you made $200,000, then it's $900,000 is the max loan amount. And if you're over that, then there are capital charges to the lenders, which are very prescriptive, that really eat into the ROE and are very punitive. So what's happening now is in England, they abandoned.
Just so I'm clear, that's based on portfolio.
Yes,
and it's
portfolio.
It's by quarter.
By quarter.
Got it.
And they tried to look at, could you do it on a transactional basis? It wasn't manageable. And in England, they did it, and they abandoned the stress test. But OSFI, in its wisdom, has kept both for this year. So we have the stress test and the LTI. And people are going to say that the stress test was successful on interest rate shock. And Peter was quoted this week at the RBC conference that all the CEOs attend at the beginning of January, saying, that the LTI, will see how it goes this year. But Peter would admit that the rationale for the stress test, which was introduced by his predecessor, no longer exists. And so when we were in a higher interest rate environment and people were actually, the coupon rate was above 5, why were we underwriting them at 7? Made no sense. We're not going to have
8.
Sometimes higher. But we're not going to have that environment. Nope. Even now with rates are falling, the reality is that they may have paused now, depending on what happens in the U.S. and the job numbers today in Canada and the U.S. And people are saying that we won't have another 50 basis points. The next Bank of Canada might be 25. But we're in a falling rate environment. Maybe it will stabilize. But there is no rationale, in my view, for having the stress test today.
So what will we see from a bank? Any bank, not being specific, but any bank whose LTI is skewed when they finish their
they're going to start, the private banks, who are the ones that give the biggest debt exceptions, as you know, for wealthy people that can afford it, they just can't prove income. And if you looked at their personal balance sheet, you would justify the loan amount. They won't be able to do that. And what will happen is that will put pressure all the way down the system. So those people will have to go down market in terms of credit to find solutions if they want that loan amount, because they won't qualify.
So we're going to see...
we're already seeing it as of November. It started, right? And you've seen it in December, and brokers have experienced it.
What we've experienced is changes in rules.
Yes.
That make certain types of borrowing more difficult.
Much more difficult, in my view.
So that's designed...
Because you've got to save that. This is the tough part for if you're inside the bank trying to manage this, in my view, is that you want to save that 4.5 times for your very best customers.
Existing very best customers.
Exactly. Yeah. So what do you do if, how do you make a case to get that loan now and you're not in that universe? Very hard, in my view.
So
they're just cutting it off. They're not letting
you coming to the bank is done.
But you'll experience this. They won't accept it at the desk now. So you won't get that price exception. They'll just say no more exceptions.
Yeah. So it's
because in the bank you can't be that agile and do it deal by deal. You'll make a hard and fast rule, and then every once in a while, then you'll bump up against exceptions. But that's going to make it tougher to do those deals.
By shrinking the credit box, you look after the LTI issue.
Correct.
Got it. And although there will eventually, in theory, be a point sometime where you're doing better than you expected. But that could take some time. So we are, as I've talked about on the show before, we're in this bizarre world of, even though rates are coming down, the economy is faltering, particularly in Ontario, and it's going to be harder to get a mortgage. And yet we've added 3.5 million people, a ton of them coming just to Ontario. And British Columbia, and a bit to Alberta, some to Montreal.
Yeah, you're new to Canada. It's even tougher, and it's going to get harder. If you're self-employed, it was tough. It's going to get tougher. If you're in that credit box, as you say, and you don't fit, it's going to get tougher. The exceptions won't be granted, and it'll move that choices downstream for those borrowers.
So and then finally, the final nail in the coffin, just to put it that way, is that under the new government, keep talking about the new government, they are going to proceed on digital verification through CRA.
I hope so.
No, that I've talked to all the critics involved, and they're going to be in the cabinet, and it's a law. It's a law and order outfit, right? I mean, that's what they hang their hat on, and certainly the idea of mortgage fraud is something they're not.
Well, soft fraud would go away, not completely, but would go a long way away if we could get CRA confirmation.
So we'll have it. And so that
but it won't happen. What'll happen like the Phoenix Pay system? Like it'll happen like in government when they screw up whatever major initiatives. Like when you say, well, it happened, like who's paying for the technology? Who's going to do it? Right?
Well, you know who pays. The bank pays.
No, I understand. But I'm just saying it'll take longer than you're saying.
I think we're going to see it by the end of this year or Q1.
Well, we have it in the U.S. and we should have had it 10 years ago, 20 years ago.
Long time ago.
But that's a good thing. I'm absolutely 1,000% in support of that.
So we'll see it. So everything we talk about basically pushes certain groups of people who want to have a mortgage into a unregulated realm. I think that's a fair statement, right?
Well, I mean, you're speaking to one of those unregulated realms now, I guess, with Maple Financial, as our new endeavor is to be in that private space, and you're not unregulated in the sense that there are provincial regulators,
Course,
so
yeah.
and there are money laundering standards, and there are audit standards.
No
and,
escape from AML. That's never happening.
and audit as well, and so I think that's a good thing, because the Maple Financial model, as I've discussed, that we're rolling out, and I'm pretty excited. We signed some third-party agreements, but we'll have direct funding probably by the beginning of next month. We want to bring
a breakthrough.
Yeah, big breakthrough. Looking at term sheets and trying to sort this out. It takes a long time in Canada to come to those kinds of terms, but I think we're there. And the reality is that our approach is to look at borrower capacity and bring the same kind of regulated rigor to that private space, for two reasons. Because in the private space, they just look at the dirt and the equity. And what happens when you do that is you're not looking at borrower capacity. And what you really want to know is the ability of the borrower to pay it back.
Yeah, I love this stuff. But let's also talk about the fact that...
But let me finish. The other part that we're doing that isn't happening, where you and I have talked about where consumers can be put in a bad place, is that there are two aspects. We want to look at borrower capacity, bringing the BRM model for efficiency and capability, just like I did in the conventional space, in the regulated world, to the private space, so that brokers who have tons of pain point in the private space will get the same value proposition and service in this private space with Maple Financial. At the same time, we want to look at the borrower capacity. We want to look at the exit strategy. So I want to know that a borrower that we take is going to be rehabbed or has a place to move. And what's happening now, and you and I both witnessed it, is that borrowers are put into circumstances in the private space with loans that they can't really manage. And then when it comes up for renewal, they won't renew them. And then they get ground down in fees and can end up losing their home. And I want to avoid that. I think the mix, and a lot of the players in the space, credit unions, et cetera, are very balkanized. They have a very narrow outlook. And I'm fortunate in that I've lent out billions and billions of dollars and have a much more macro look at this, and know that all of these things are still possible in the private space. They just haven't been done before.
Sure.
And I think a lot of the bad behavior we've seen is attributable to that lack of transparency.
Let's talk about bad behavior for a second. So we have some new revelations that have come out this week about the you can only call it infamous Claire Drage promissory note fiasco.
Crazy.
Absolutely crazy. We've talked about it on the show many times.
A mortgage broker with Mortgage Alliance, with M3, writing promissory notes, which allegedly is nothing more than a Ponzi scheme, and money disappearing, moving all over the place, but allegedly being processed through Mortgage Alliance bank accounts and them taking a fee out of that. To me, that's just shocking, Ron. I don't know how that happens. And then you're in Sudbury, the Sioux, or Timmins. That market for investment properties is done for a decade.
Oh, it's destroyed. Yeah. Completely destroyed. So we're talking about a bunch of crooked developers who were and supplied by very poorly underwritten mortgages. And
not underwritten at all.
And then to make matters phenomenally worse, run out and get promissory notes to do construction, which barely ever happened.
They were flipping. They were buying houses and allegedly going to improve them, and
meantime they're on private jets to Vegas with strippers with a stripper pole in the jet. Every possible bad thing you could imagine, every worse element of the horrible 2008 disaster in the United States was in clear view. It was on their Facebook pages. It was on their Instagram pages. And yet we have it's nothing's happened yet. Thank God. Apparently the OPP is launching.
Apparently the OPP racketeering squad has a criminal investigation. There are multiple civil suits, for one case, $255 million, like big money. The defendants will have to spend their time and answer
if they're in the country.
If they're in the country for that civilly, but now criminally. But what bothers me is that, you know, the lawyer for Mortgage Alliance is saying, well, look, this is an OSC issue. This is a regulated issue for us in terms of whether it's FSRA in Ontario. to me, that begs the question, like what we need to do as an industry is constantly police ourselves, because we know that in terms of fraud, police forces and regulatory agencies don't have the breadth or the deep
Or the level of
pockets
interest.
or the level of interest to do that. So we have to clean up our own industry. And I've always
100%.
said that.
100%. By the way, we can't just pick on M3.
No, Forest City in London,
The Forest City fiasco.
in the DLC group had it had their own MIC and realtors and a similar kind of
a different twist, but in essence, this is taking advantage of both institutional lenders and the public, but and the borrower more than anything else.
But financial intermediaries have to be responsible and be ethical and with integrity, and put borrowers into deals that are appropriate and suitable. And these people were just letting greed run wild. But and I know there's always going to be bad actors, but what disturbs me, if some of the largest organizations in the brokerage world are allowing that to happen under their watch, are we asking enough tough questions?
That is the key. The right question is to say, why does it have to go into receivership, or why does it have to become a FSRA notice of a FSRA NOP? Why do we have to get to that point before any network has got any awareness of what's going on? That's a big point.
I don't think it should. I don't think the leadership of those groups, that's their intention. But what I think we all have to do in the industry is top of mind. Remember that the biggest risk for mortgage brokers and for them as financial intermediaries and for lenders that deal with them as their dominant distribution channel is reputational risk, because that's what will cause the problem. So these are tragic issues for some of the borrowers and investors, but the real point for me is, what damage does that do to the industry as a whole?
Exactly. So this key element of reputational risk, just so that all the listeners understand, the idea of reputational risk is that the bad actions of a few do enormous damage to the reputation of the industry, to the point where both regulators and the general public decide we don't want them there.
Regulators, the general public, investors,
you name
analysts, anyone that touches the space. I mean, if you do this now, and you're out in these conferences, you talk to bank analysts, institutional shareholders. We've spent the last 10 years improving the image of mortgage brokers, only to have these kinds of things happen, and it's a huge setback. When we had the crisis at Home Trust, that did damage right across the space.
Yes.
It was in those days at Scotia Plaza, 7th floor was the executive suite. It was a 911 every day, right? Like we were answering questions about, was our business at risk because of the behavior of people we never dealt with or wouldn't have dealt with on those terms. And it's like a run on the bank. That's how reputational risk. It's like a wildfire in LA. You don't want it to be sparked by some unscrupulous agent or broker who doesn't really have a stake in the game, or if we don't police ourselves, no one else is going to do it for us.
Yeah, just that individual working off their own private greed.
Yes.
To grab a buck and lie their way through the situation is what's devastating for everybody who chooses this as a career.
Because I don't think people understand the implication of reputational risk. That's what makes BMO pause before they get into the space, because it's myth making about, these are all broker driven customers that do this, or their customers don't renew, or their customers don't cross sell. Well, they got way more fraud, even though you and I both know that the quality of the broker originated business is best in class. But then you get a few of these stories, and the next thing you know, the risk officers and the shareholders and the boards of directors don't believe it anymore.
Exactly. So, all right. It's something that we do spend a lot of time on this show about, and we're probably not going to find an answer today. But I'm curious now about this. Is really interesting that you've gotten. I know you've been working on this for a full year, if not a little bit more. So, in the new iteration of Maple Financial, what is the goal? I understand it that the idea is to provide a much more efficient much more and also rigorous approach to developing private lending for people who, through all these different endless tightening of boxes in the mortgage space, need a mortgage but can't get a mortgage from an institution.
Right.
So,
So
tell me more about it.
I think there are two things. One, no one's ever scaled it on a national level. So to begin with, like, we're regulated and licensed in Ontario, Alberta, and BC, and we'll start in those places,
Mhm.
and then add on territoriality as that makes sense and funding allows. And what it really means is to provide that kind of rigor on the underwriting side to give confidence to investors that you can invest in this space that isn't part of the federally regulated financial institutional world, but still regulated by province, but get the same kind of standards that are being applied both to underwriting and to picking the right loan for the right borrower, regardless that it's private, not just trying to make a quick buck and squeeze someone at renewal, and have an exit strategy. And I think that that's a growing part of every broker's practice. When I first started having this dialogue with brokers, some of them were doing maybe 10, 15% of their practice. Now, many of them are doing 30%. And it's really a regulatory arbitrage, because as it gets more and more difficult, there's more opportunity to do business. But the problem in the space is it's everything from true privates that are streets to what they call Alt-A. But I could show you deals. They're the same.
They're the same. They're the same people.
They're the same.
Yeah.
Yeah. So what I want to do is provide an outlet so that you get that kind of service and the customer can be served and pay an appropriate rate for the risk reward, and do it on a way that you can scale it. Because what the mix are doing, they do a couple $100 million and
They're done.
And they roll it over, and that's not what I want to do. I want to build a national lender that can compete in that space and do it with the same kind of value proposition, the same kind of efficiency and efficacy that I did at Maple Trust and I did at Scotia Mortgage Authority, but bring it to brokers, but only the brokers that respect that process.
And
but the same BRMs, right? So Rob Lowe was our first one. He was a star as a BRM at Scotia. He decided to leave the bank. We've hired 3 other BRMs that are going to start as the funding begins.
It's going to really ramp up.
And the first couple of years, it'll be satisfying lenders and others that this is being done in a responsible way. And I think that we can do that. We have a partner who's very successful in the auto business called CanCap, and they've had a lot of experience in the near prime, subprime, and auto, but they also run the CIBC auto business, and they were attracted to the mortgage space. And I think the combination of the two of us, in terms of our experience in the mortgage lending, will allow us to try to leverage. There's very limited technology in that space, so I spent a lot of time trying to figure out the plumbing, and I think we've done that and seeing what the opportunities are. And I think that the space is very balkanized, that no one is really certain what they're going to get or when they're going to get it. And I hope to address that in a successful way. And I think that it'll take a couple of years to really ramp up, but I think that 25 will be a very successful year for us in terms of whatever liquidity that we're able to get, we'll be able to put that to use. And in my experience, what happens, Ron, is as you're negotiating for both liquidity and equity, once you start to get people, then all of a sudden you get more people.
Yep, always true.
I've spent a lot of time kissing a lot of toads to try to find a prince, and so like now we're getting closer. Liquidity is always the scarcest resource in this business.
Ain't that the truth?
And that's one thing that brokers never really fully appreciate, is where does this all money come from, right? Like banks have an advantage because they got retail deposit networks. There's wholesale funding. They understand some of the securitization. But if you ask Stephen Smith or Usury what makes them successful at their jobs, is because they understand how to raise liquidity.
Yep, 100% true. Yeah, that is the essence of it. So let's close on this one thought that I extracted that I thought was probably other than the desire to see a great, successful national lender in that space, let's talk about the thing that I thought was the most appropriate, is that there will be true, as opposed to bullshit, exit planning for the borrower. That there will be a natural path. Hey, 1 year doesn't really work for you. You should really take a 3-year, and you should have a longer term on this. And and if you don't hit these marks, you're never going to be able to get out of this. And we don't want the idea is not to harm you with high fees at renewal and jam you,
right,
and cause you to get and be a much worse
or
situation.
put a broker in a position where that's their only option to provide that to a customer.
That ain't right. Yeah.
That and I feel for them because they're trying to find a solution. A mortgage solution for a customer is a difficult fit, and then they're put in that position where they have to say, "Ooh, I know this doesn't feel right, but I got to charge this rate. I got to charge this fee," and the borrower, you're on your own. That isn't necessary. By looking at the borrower capacity, those are the predictive elements that will allow you to know whether there is a capacity to repay. It's more important than the LTV or the real estate, right? But in my experience, the space is dominated by people that basically grew up in the Jerry Soloway way, right? What I call the home lending.
Lend on the property.
Jerry was always great. He used to say, don't lend against the best house or the worst house on the street. And don't go above this LTV and only do these geographies or this community.
Yep.
And then hammer the shit out of them at renewal with NSF.
I'm not sure he hammered the shit out of them every
he'd
time.
be out there reading the files. You and I both know it. And I get that. It's a good business,
yeah,
right? But that's not a scalable business in my view. That's a different philosophy of lending than I've had. And I want to assist brokers who want to assist their customers regardless of where they are on the spectrum. But I want to be able to do what used to happen and rehab that credit so then they can transfer in to a regulated financial institution at a lower rate ultimately. I don't want to have them captive or grind them out. Right? That's not what the ambition is. And I think that everyone knows in any successful business will be rewarded based on how well you treat your customers.
Yes, that is 100% true. And John, to close on that, thank you. It's a great session. And hey, folks, those of you here in the mortgage business who are listening, mortgage brokers, mortgage agents, even some of you realtors, think about Maple Financial. It's coming soon, getting bigger. Growth is on the way. And this is a legitimate, great opportunity to stand up something that's efficient and consistent in that space. So thank you, John.
Well, thank you, Ron, and thank you for all that you do and for all the support you've given me over the years.
My pleasure.
If you like the pod, well, don't just sit there. Go to YouTube, Apple, Spotify, and all the other ones and like the pod. And don't forget to subscribe so we can keep being angry at mortgages and swearing about mortgages. Angry Mortgage could use your support.